Welcome back to the deep dive. Today, we're doing something we often like to do, revisiting a company we've looked at before.
Okay.
Our mission, well, it's the usual. Take this pile of sources on IOI Properties Group Berhad, IOIPG, and their latest quarterly report, and really help you cut through it all to figure out what matters most right now.
Exactly. We've got the results for the quarter ending March 31st, 2025. That's their Q3 for fiscal 25. And we've also got analyst takes from MEDF, TA Security, some news coverage.
And a big acquisition announcement, right? Very recent.
Oh, yeah, that just dropped. It definitely, changes the picture a bit. So lots to unpack.
Okay, let's get straight into it. Looking at the headline numbers, say for the first 9 months of their financial year, compared to last year, it's not looking great, is it?
No, not really. The 9-month core net income for FY25, it's down pretty sharply year on year. We're talking a 45.6% drop.
Ouch, nearly half.
Yeah, it's a big hit to the bottom line.
But hang on, if you just isolate the latest quarter, Q3 itself, was there maybe a hint of things, steadying out?
There was actually. Comparing Q3 of 25 to the quarter just before it, Q2, core net income did tick up. It was up 16.2% quarter on quarter.
Okay.
So yeah, the year-on-year number looks rough,
Uh-huh.
but sequentially the last 3 months showed some, let's say, stability or slight improvement.
Right, that quarter-on-quarter bump is interesting. But let's drill down on that big year-on-year fall. What's the main driver? What's really dragging things down?
The single biggest factor, the thing that really leaps out from the numbers when you compare it to last year, is a massive, massive hike in interest expenses.
Okay, massive. Let's put a number on that because it sounds pretty dramatic.
It really is. Get this. Interest expenses went from just RM 590,000 in the first 9 months of FY24
Right.
to RM 328.5 million in the first 9 months of FY25.
Wow. Okay, wait. From 500,000 ringgit to over 300 million, how on earth does that happen?
So that huge jump is mostly tied to one specific thing, the interest costs for their big Singapore project, the IOI Central Boulevard Towers, or IOICB. Think of it this way. While they were building it, the interest on the loans for construction was basically added to the building's cost on the balance sheet as capitalized.
Right. Standard practice.
Exactly.
Huh.
But once the building's done, which IOICB was in July 2024, those interest costs stop being capitalized and start hitting the profit and loss statement every quarter as an expense.
Ah, I see. So it's not necessarily that they suddenly borrowed a ton more money in that period, but more about how the accounting treats the costs for that existing project once it's operational.
That's pretty much it. The accounting treatment flips upon completion, and boom, you see this huge increase impacting the reported profit. It's a direct consequence of bringing that major asset online.
Got it. That makes sense now. So with those financing costs surging, what about the actual underlying business? How did revenue hold up?
Well, group revenue for the whole 9-month stretch was actually pretty stable year on year. It was up slightly, 0.7%. Now, if you look just at the latest quarter, Q3, revenue was down compared to Q3 last year, about 15% lower. But it was actually up a little bit, 3.6% compared to the previous quarter, Q2.
So overall sales activity wasn't the main culprit for that big year-on-year profit drop then?
No, not really. It was overwhelmingly that spike in interest expenses.
Okay, let's break down that revenue. Where is it coming from? How did the different bits of the business do? Let's start with property development.
Right. Property development in Q3. Well, revenue there was down significantly year on year, about 41%. Operating profit also dropped, down 12%.
Why such a big fall compared to last year's Q3?
That was mainly because in Q3 of the previous year, they recognized a pretty large land sale. That didn't repeat this year.
Ah, okay. So a bit of a one-off boosting last year's number.
Exactly. Makes the comparison look worse. However, if you compare Q3 to Q2, this year, the profit before tax for development was actually up 35%.
Oh, interesting. What drove that sequential improvement?
That was mostly driven by better performance out of their China operations. They've apparently been doing some strategic price adjustments on completed properties over there, specifically at the IOI Palm International Parkhouse project.
Right.
And that seems to have helped shift some inventory and led to a gradual sales pickup there.
And where were the main sales contributions coming from in Malaysia? Still the core?
Oh, yeah. Malaysia projects really carried the load for the 9 months, 90% of total new sales. Mostly from the usual spots. Klang Valley, think IOI Resort City, Bandar Puteri Puchong, and also down in Johor, places like Bandar Putra Kulai and Teman Kepis Utama.
Okay. Now, property investment, this segment usually seems pretty solid for them. Still the case.
Absolutely.
Yeah.
Property investment had a really strong Q3. Revenue was up 62% year on year, operating profit up 78%. and both were also up compared to Q2.
Wow, that's significant growth. What's behind that?
It's a combination of factors. First, they're getting contributions from the IOI Mall Damansara, which they bought back in December 24.
Right, the new acquisition.
Second, you've got that recurring lease income finally kicking in from the IOICB towers in Singapore that started generating income from April 24. And third, their big mall, IOI City Mall, apparently had a record quarter.
All right.
Plus, one of their office towers in Putrajaya, IOI City Tower 1, is apparently almost fully leased out, close to 100% commitment.
So that strategy of building up those steady income-generating assets is really paying off, helping buffer things.
Definitely seems that way. It provides a good foundation.
Okay, what about the third leg, hospitality and leisure, hotels and such?
Right. Hospitality and leisure saw higher revenue in Q3 year-on-year, up 42%. That's mainly from contributions from fairly recent acquisitions like the WKL and Courtyard Hotels.
Okay.
And also the opening of new ones, the Moxies that opened in Feb 24, and quite recently a new Sheraton Grand Hotel in China, which just opened its doors in March 2025.
More revenue sounds good, but I thought I saw the operating loss actually got bigger.
You did. Yeah. Despite that revenue jump, the operating loss in Q3 widened year-on-year. It went from about RM 3.4 million loss to an RM 11.4 million loss.
Why is that?
It's mostly down to the costs of getting those new hotels up and running, particularly that big new Sheraton in China. You've got, pre-opening expenses, marketing pushes to get the word out, and then depreciation starts hitting the books right away.
Right, before it's really earning its keep.
Exactly. It's pretty typical for new hotels to lose money initially while they ramp up.
Okay, got it. So looking at the overall picture for new property sales across the group, how did that track?
New sales in Q3 specifically were RM 447 million. That was actually up from Q2, which saw RM 361 million.
Okay, a sequential uptick there too.
Yeah. But for the full 9-month period, total new sales were RM 1.14 billion, and that was down 28% compared to the same period last year.
And that year-on-year drop for the 9 months, again, linked to that land sale point you made earlier.
That's a big part of it, yeah. The prior year's 9-month figure was boosted by that RM 365 million land sale, which didn't repeat.
Makes sense.
Out of that RM 1.14 billion in new sales this year, Malaysia was, as we said, the lion's share, 90%. Overseas was 10%. Their unbilled sales contracts, signed but not yet recognized as revenue, stood at RM 718 million. That gives some visibility for future earnings.
Okay. Any other lines on the sales front?
Yeah, one positive note was they seem to be making progress selling off their completed inventory, unsold finished units. They reduced that stock by about RM 346 million over the 9 months.
Wow, good for cash flow.
Exactly.
Yeah.
Turns those assets sitting there into actual cash. The remaining completed inventory is about RM 1.57 billion.
Okay, so that covers the operations and sales side. Now let's shift gears to that really big recent news, the South Beach acquisition in Singapore, announced just, June 4th?
Yes, this is definitely a major move. IOIPG, through a subsidiary, is buying the remaining 50.1% of a company called Scottsdale Properties.
And Scottsdale owns.
It owns the South Beach property in Singapore. So buying this stake means IOIPG will own 100% of South Beach.
That's a pretty iconic development in Singapore, isn't it? What exactly is in the South Beach property?
It is. It's a large mixed-use development. You've got prime office towers, retail space, and also the JW Marriott Hotel, Singapore South Beach. It's quite a complex.
And the price tag for getting that remaining half?
The deal values that 50.1% stake at roughly $834 million. That works out to about RM 2.75 billion.
Okay.
And that valuation is based on Scottsdale's net assets, with the entire South Beach property itself valued at a hefty $2.75 billion, or around RM 9 billion.
RM 2.75 billion, that's a serious chunk of change. How are they planning to pay for it?
The announcement said it'll be a mix. Some internal funds, so their own cash, and also bank borrowings.
Right. Probably quite a bit of borrowing needed for that amount.
You'd think so, yeah. They didn't specify the exact split, but given the size, borrowings will likely be significant.
So what's the strategy here? Why buy the rest of it now? They already had basically half.
The stated rationale is pretty clear. They want to increase their ownership of these high-quality, income-producing assets in Singapore. Owning 100% means they get all the income stream from the offices, retail, and hotel.
More stable, recurring income.
Exactly. Plus, it significantly boosts their profile and presence in the Singapore market, adding to the IOICB towers they just completed. It's like they're doubling down on their Singapore investment portfolio.
Makes sense strategically. What about the financial impact? How is it expected to affect their earnings and balance sheet?
Well, it's expected to actually increase their earnings per share, EPS. A big chunk of that, initially at least, comes from an accounting thing, a one-off gain.
How does that work?
Basically, when they buy the remaining 50.1%, they have to remeasure the value of the 49.9% stake they already own up to the current transaction price. This creates a paper gain that flows to the P&L.
Ah, okay. A non-cash gain.
Right. But beyond that one-off boost, EPS should also benefit going forward because they'll be consolidating 100% of South Beach's earnings into their group results instead of just their share, and should also enhance their net asset value over time.
Okay, strategic logic seems sound. Income, presence, some accounting benefits. Is the deal done, or are there hurdles?
Not done yet. It's conditional. They need to get approvals from various third parties.
Like who?
Lenders associated with the South Beach property itself, the hotel operator JW Marriott, and also the trustee for some bonds related to the property.
Okay.
Assuming they get all those consents, they expect the deal to close sometime in the second half of this calendar year, 2025.
Right. And this acquisition, especially the funding part, brings us squarely back to their financial health. Specifically, debt levels, gearing. You flagged the high interest costs earlier. This must be a key focus area now.
Absolutely. Net gearing is probably the critical ratio everyone's watching. Yeah. MIDF noted that their gearing was already, let's say, elevated at 0.75 times after they bought the IOI Mall Damansara last December.
And what are analysts forecasting now, maybe before factoring in South Beach?
TA Securities had estimates around 0.715 times, or 71.5%, for this fiscal year, FY25. Maybe improving slightly to about 0.687 times in FY26. But again, that's likely pre-South Beach impact.
So the billion-dollar, or rather RM2.75 billion question. Yeah. How much could buying the rest of South Beach push that gearing up?
Well, IOIPG's own announcement about the deal included a pro forma calculation. It's based on older figures, June 2024, but it indicated that net gearing could potentially jump from 0.70 times up to 0.93 times. That's assuming the purchase is funded mainly through borrowings.
Wow, okay. Pushing close to 1x net gearing. That's quite high for a property company, isn't it?
It's certainly up there. It really highlights how significant the leverage impact of this deal could be, depending heavily on that funding mix they end up using.
And their total debt was already climbing slightly even before this, right?
Yeah, looking at the balance sheet, total borrowings went from RM 19.17 billion in June 2024 to RM 19.45 billion by the end of March 2025. So the debt pile was already creeping up.
We saw the impact of interest costs on profit earlier, that massive RM 328.5 million for the 9 months. The sources didn't give a specific interest coverage ratio, did they?
No, not a specific ratio number. But that huge interest expense figure itself tells the story. It clearly shows how much of their earnings are being eaten up just servicing the debt, significantly reducing their profit before tax.
Yeah, it really highlights the pressure from their debt load.
Especially in a higher interest rate world. It underscores that sensitivity.
Did the sources mention anything about whether they're comfortably meeting their debt covenants? Any concerns there?
No, the reports we looked at didn't go into the specifics of their debt covenant compliance status. That detail wasn't provided.
Okay. What about other metrics, like return on equity? How's that looking?
Also reflecting the lower earnings, TA Securities is forecasting ROE to be quite low, around 1.7% for FY25. That's down from 2.3% last year and 3.0% the year before.
Right. Lower profit means lower return on the shareholders' equity. Makes sense. So, pulling together the high debt costs, the big acquisition, what are the main risks and challenges really facing IOIPG right now, according to these sources?
Well, number one clearly is that high interest cost environment coupled with their debt sensitivity. The elevated gearing, potentially rising further, makes them vulnerable if rates stay high or go higher. That was explicitly flagged as weighing on earnings.
Okay. What else?
Another one mentioned is specifically related to the Singapore market, particularly office vacancy. There was a note in Bloomberg that Meta gave back some space at South Beach Tower.
Oh, interesting.
Yeah, which apparently nudged the occupancy down slightly to 92.4% at the end of March, from 94.4% end of last year. MIDF also pointed to Singapore vacancy as a key risk to watch.
What about China? Still facing issues there?
Seems so. The reports mention ongoing market headwinds, geopolitical stuff. General economic challenges in China are still a factor. Even though they've had some success moving inventory with pricing strategies, the overall environment there is still seen as challenging.
And broader global risks.
Yeah, the usual suspects, global business conditions, trade uncertainties, those persist too.
And finally, specific risks tied to the South Beach deal itself.
Definitely. There's always execution risk. The deal might not even happen if they don't get those third-party consents.
Right.
And even if it does close, there's the risk that future changes in Singapore, political, economic, regulatory, could negatively impact how that big asset performs for them.
Okay, quite a few challenges on the radar then. But despite all that, what's the general outlook? What are the prospects mentioned?
Well, despite those headwinds, the company itself is apparently guiding for a satisfactory financial performance for the full year, barring anything majorly unexpected.
And what gives them that confidence?
It seems to be based on their diversification, having operations across Malaysia, Singapore, and China. They're not reliant on just one market.
What about their strengths going forward?
The big one is that growing reliable income stream from property investment finance, the malls and offices we talked about, that provides a solid base.
Right, the recurring income.
Exactly. Also, the outlook for hospitality and leisure is seen as improving, helped by things like marketing campaigns trying to draw visitors, like one called Visit IRC for IOI Resort City.
And progress on the big Singapore projects.
Yes, IOICB, the big office tower, is reportedly still gaining leasing momentum. They've hit 80% lease commitment now, which is seen as positive. And their other major Singapore development, the W Residence's Marina View, is apparently moving along steadily in construction.
Okay, so let's try and wrap this up. What does this all boil down to for you, the listener, trying to get your head around IOIPG from all this information?
Well, I think you've quickly grasped the main points. You understand that big headline drop in profit year on year. It's not necessarily the core business falling apart. It's mainly driven by that huge accounting shift in interest cost now that IOICB is finished.
Right, and you see the different parts of the business are performing differently. Property investment is the star, really strong, giving them that stable income. Hospitality is growing revenue from new hotels, but taking initial hits on profit.
In property development, revenue looked down year on year because of that old land sale, but sequentially it improved. And they are seeing some movement in China by adjusting prices.
And critically, you understand the big strategic bet they're making, doubling down on Singapore by taking full control of South Beach. You see the upside, more stable income, bigger presence, but you also see the key financial implication, potentially pushing their already high debt levels even higher.
Exactly. And you're aware of the tightrope they're walking, managing those significant debt costs, navigating the Singapore market risks like vacancy, dealing with China, and just the broader economic climate.
That was our deep dive into IOIPG's latest quarter and big strategic move. It's really interesting to see a company in this phase shifting from major development spending to focusing more on the income from those assets, but then also layering on another huge acquisition.
Yeah, it really throws a spotlight on that balancing act between growth ambitions and managing the financial realities, especially leverage.
So here's maybe the really interesting question to ponder. Given that their gearing is already quite high and interest costs are clearly biting into profits, how do they successfully juggle funding these big future investments, paying for South Beach, finishing W Residences, maybe other things, while also needing to manage that debt load and actually improve profitability, especially if interest rates stay where they are or even tick up?
That's the core challenge, isn't it?
Yeah.
Balancing growth with prudence. How do you keep investing for the future without overstretching the balance sheet today?
Definitely something to think about. Until our next deep dive.